Alright, so in continuation from my previous video, this is second video. So we'll continue from where we left in the last one. Alright, so let me bring up that Excel spreadsheet. Okay, here it is. So what we've discussed so far, we've discussed how to calculate the returns, right? How to calculate average return, how to calculate the standard deviation using the Excel formula, and also how to calculate if you want to calculate using a formula manually, what you can do, you know how to calculate variance. And standard deviation is nothing but it's an square root of the variance. So you can see the formula as QRT. It's Excel formula of M3. M3 is nothing but your variance, average variance. Okay, so so far so good. Now we were discussing about risk or the variability of the return. Okay, so here returns on average have varied 11%, which means they can go from average return 3%, they can go plus minus 11% any which ways, right? So if markets are not doing well, it might go down 11%. If market are doing too well, the stock of Amazon might go up 11% on an average, right? So there's something called normal distribution. Anyway, I'll not talk about normal distribution in this video. We'll cover it sometime later. But for the time being, let's move on. Okay, so this is a fairly risky stock because there's a lot of variability, even though it's giving 3% return. Okay, so we talked about some safer investment, right? Safer investment can also be called as less risky investment, or less risky investment can be called as investments where variability of return is not too much. Okay, so we talked about something like investing into bonds and holding it to maturity. But do you really hold a bond to maturity? For example, if it is 1 year, 2 year, yes, you can hold it to maturity. But if you're an individual investor and you have some requirement after, let's say, 6 months, after 1 year, you might want to liquidate your investment. So you may not hold your investment till maturity, right? So and also there are a lot of other factors which actually impacts the bond prices on a daily basis. All right. So let's say what I've done, I've taken a ticker called TLT. It's a treasury 20-year 20-year treasury. And if you want to know what exactly is this, let me see if I can pull up. Okay, I don't have it. So this is 20-year treasury bond. Okay, and for this particular bond, I've taken the prices for again a monthly prices, and then did the same thing what we've done earlier, calculated the monthly return. But as it's a treasury, probably it might be less risky compared to a stock. And secondly, it's being a government bond, a treasury bond, it might be even further less risky. So let's see how the returns, what is the average return it has given to us, and what is the average risk or standard deviation of this particular bond. Expectation is should be less than the stocks. All right. So let's find average starting until end, parenthesis closed. So on average, it is given 1% monthly return. We must be thinking it's too less, but let's say proportionately it should be less risky in terms of variability of the return also. So let's calculate. Let's calculate directly the standard deviation. Okay, so compared to our Amazon stock, which was giving you 3% return average and 11% variability of those return, Treasury is giving you 0.68% return on a monthly basis, and the standard deviation is also very low, 4%, almost 1/3 of what was there for your Amazon stock. All right. So So I'm trying, what I'm trying to impress upon is that you should be able to appreciate what is average return and what is the variability of those returns. All right. So if higher the variability, higher the risk as in financial sense, lower the variability, lower the risk. Okay. So let's, for sake of completeness, let me pick up one more stock. This is like Arena Pharmaceuticals. One of the drug got approved recently for obesity. But like it's a small cap pharma stock which has some drugs in pipeline. So, and not generating sufficient amount of cash. So liquidity issues and all kinds of things. So so expectation is that this stock will be fluctuating too much because it has not yet reached that maturity stage the company needs to be. So again, I have downloaded the price from Yahoo, and again we're doing the same thing one more time. This is the monthly return, and then the standard deviation of those monthly return, and here you can see it's 25% is the deviation. So on a monthly basis, the return of this stock can vary 25%, right? This is like one standard deviation. Okay, I will talk about what is 1, what is 2, and what is 3 standard deviation, like how much area or how many values will be within 1 standard deviation, how much value will be covering in 2 standard deviation, and stuff like that. Okay, I'll do some separate videos on those ones. Okay, so now you have very good understanding of average return and average risk. Okay, so how do we minimize risk? Again, diversification. How do we diversify? Can we find 2 stocks which are kind of, before I go further, let me talk about correlation. Okay, because diversification is basically the principle behind diversification is can you have more than one investment, in which if one investment goes down, other investment goes up, and vice versa. So what will happen? On an average, your returns may not be that much variable. For example, one stock went down 2%, but other stock went up 2%. So on an average, -2, and if the value is same, so probably you will be getting 0% return, but of course the variability has gone. Okay, or let me give one more example. One stock went up by 5%, the stock went down by 3%. So you, on average, you got 2% return. If you would have holded let's say 2 stocks individually, only stock 1, then your stock would have been gone down by 3%. In this case, the variability would have been -3%. If you must be holding stock 1, which went up by 5%, in that case, your stock would have varied by 5%. So from -3% to +5% is a good amount of variability. But if you're holding both the stocks together in your portfolio, then -3 plus 5, your resultant variability is only 2%. So this is the result of diversification. Okay, so you have to find out how the 2 stocks are correlated. For example, let's say Tesla and ExxonMobil. Okay, ExxonMobil makes gasoline, which is used in the cars, and Tesla is an electric car company. So more and more people will switch to Tesla, the electric car. There will be less and less demand for ExxonMobil's gasoline. So essentially, if Tesla is doing well, that should mean that ExxonMobil should not do well, because people may not be buying that much of gasoline, and other way around. If people are buying too much of gasoline, means they are using too many gasoline based cars, and in that case people are not buying too many electric based cars, so the stock should be negatively correlated. So to explain the concept, what I've done, I've taken 2 ETFs, ERX and ERY. So ERX is essentially, it's an ETF for companies which are into energy sector, whose the main revenue source is predominantly the oil, right? S&P, Standard Oil, ExxonMobil, British Petroleum, and companies like those. And ERY is the negative or the inverse. So this one is bullish on energy companies, this one is bearish on energy companies. So what do? They actually short these companies. So their return, this ETF is trying to mimic the performance of the companies which are into energy sector. Okay, and this is trying to do the inverse of the return. Okay, so what I'm going to do, I'm going to just calculate the correlation between the return of these two companies. All right, so first of all I have to find the average return. So I'm going to do monthly return, which is my adjusted close toward my previous month close minus 1. All right, I'm going to do the same thing for the other one also. Let me see if I have got everything. Yep, I don't need this last one because there's nothing. Same thing over here. Now I can find how these two stocks are correlated. Okay, so I can use a formula directly. Correlation. So which is my area 1? Let's say this is my area 1, comma, which is my area 2. So this is my area 2. Enter. So the expectation is that these two stocks, so one is positive, one is negative on the same set of companies. So essentially it should be negatively correlated, because if one goes up, means if the energy sector companies are doing well, so ERX should do fine. It means the companies who we are actually betting against energy companies should do poorly, so that should go down, right? So essentially these two set of ETFs should be negatively correlated, and let's see how they are. Okay, here we got, so they are almost 95% correlated. So it's negative correlation, it's almost 100% correlation, but it's negative, and which was kind of expected. All right, so I think we discussed upon portfolio, little bit of we touched upon diversification. Let me tell you one more concept. We discussed standard deviation. Okay, here it is. I wish I could have shown you this chart earlier. So this is a chart of monthly returns, and you can see how the monthly return is fluctuating. So I have made this average line of 3%, and on that average line you can see sometimes it's going up, sometimes it goes down, right? So higher the volatility, more risky is the stock. Now let me move this chart up a little bit further. Okay, here it is. All right, so a lot of you may be knowing this. This is a histogram. So what is histogram? This is a histogram of the monthly return. So it basically plots the monthly return in the increasing order, and it also on the bottom scale, on the horizontal scale, is the return on a monthly return, and on the vertical axis is the frequency. So I have total, if I tell you I have how many values, I have 121 values. All right, so for those 121 values, on an average 43 times I got a return of this is a return I got 43% for 43 times. Once I got a return of 55% also, and once I got a return of negative 30% also. All right, so this basically is plotting, and you can see it has nicely plotted into a bell curve, or a normal curve. It looks like a bell. If you go to temple and all, you can see this kind of a bell over there. So it's called bell curve. So this bell curve has a lot of properties. There's property called we discussed upon standard deviation. So I think I have some more which I can show it to you. Let me see if I have it. Okay.